Joining us right now is former Fed Vice Chairman Roger Ferguson, who's also a CNBC contributor. Roger, Jamie Dimon said yesterday that he expects more rate hikes are going to be necessary, both for what we've seen in commodity prices and in wages. You had Jeff Gundlach telling CNBC yesterday that he thinks things like oil prices will require more rate hikes as well. What do you think?
Actually, I think they're right. And I think what the Fed pointed out yesterday is there's still a great deal of forward momentum in the economy. They clearly expect that they'll be holding rates higher for longer. And something that was also very important, they pushed out by about a year when they expect to get back to the 2% inflation target. So I am in the group that says, yes, at least one more and possibly a couple more hikes will be called for because the economy is doing, in a positive sense, very well. But that means inflation pressures aren't receding as quickly as perhaps the Fed would like.
So not just one more rate hike potentially, but several on the horizon?
Several?
I would not go several, Joe. I think that's too many. But I certainly think, more than one, potentially two. And we'll have to see. As Chair Powell said yesterday, they are, again, very data dependent. They aren't sure exactly, how restrictive they are because after putting in so much in terms of rate hikes, the economy is still moving along very, very quickly. And so I think it's a period of great uncertainty, and markets should be prepared for more than one hike.
I thought his language yesterday was interesting. It pointed to just about any and all scenarios, including, I forget exactly what his language was, but something about crisis in the markets or in the credit markets potentially, too, if you see problems there, just in the financial system itself. And that kind of shows you just what a new place we're in, where they think they've done a lot, gives some room for at least stopping and pausing and looking around, but really not knowing which path is coming next. That's an awful lot of uncertainty. Do you feel like anything could happen, Roger?
Look, I think there's a great deal of uncertainty geopolitically here in our own political system when there's going to be a government shutdown. So I do think, as you say, almost anything could happen. However, I think the odds are for more increases and higher for longer as opposed to a rapid reversal. And in part because I think the inflation dynamic is still one that's somewhat worrying to them. And as he emphasized several times, that is their primary goal and objective. So while anything could happen, I think the odds are for more in the way of hikes, as I've said, versus a quick reversal and is starting to reduce rates.
Can you allay the worst fears, maybe, Roger, in that maybe we're at the beginning of something similar to the stop-start sort of fiasco of the 70s and 80s, and the only thing that concerns me remember the oil that kind of started it back then, and then wage price spirals and union strength and wage increases, sort of the spiral that we talked about. And when I mean stop-start, could we end up at 6, 7, or 8? 2 years from now because we never really went high enough right away? That you don't think that that's in the cards? You think another, at most, maybe three 25 basis point increases, that will do it? We won't have another 300 basis points?
Well, let me allay your fears. I do not think this is the 70s. A couple of things. One is the Fed itself has shown that it's much more resolute than had been the case in the late 60s and early 70s, which is one of the things that got this started back then. And secondly, and Powell has pointed this out repeatedly, it's good news that long-term inflation expectations are also really well anchored. And so I don't think we're in the early days of a 70s kind of wage price spiral. Possibly, as I've said, Fed rates ending with a number that starts with 6 is a possibility. I don't think 7 or 8. So no, Joe, let me try to allay your fears as best I can on that.
I feel a little better.
I think the Fed is.
But, the automakers haven't had an increase, a raise in a long time. But that 40% number sort of opens my eyes to think that we've underestimated the arc of workers wanting to be better compensated, and that could be a powerful underlying force, and that maybe we're not really taking into account, combined with all the income inequality. Roger?
Look, to be very fair to your point, there are risks on both sides, for sure. And certainly unions and labor markets are certainly much more restive. Unions are much more restive than they have been for quite a while. And so I'm not completely denying that there are some forces here that are driving inflation forward. I think the Fed is very much on its game around that. And, you know, part of what's called for here, and they still have it, is to create a lot of credibility. The challenge is they create credibility only by taking action, and they're not sure how much further they have to go. But as I said earlier, I think the market should be expecting maybe more than the one that they've talked about for some of the reasons that you point out. There are a number of forces here that say maybe inflation might be getting a little bit more entrenched than we'd like, and so let's be careful. And I think what that means for the Fed is, while they've talked about, you know, the probability of one very explicitly, I would remind everyone that does not mean that 2 and possibly 3 hikes are therefore ruled out. It just means that it's not yet decided.
Roger, just in terms of what the rate hikes mean, though, in the real world, I have to say my eyes have been opened up recently trying to help a friend find housing. I mean, rents are off the charts from where they were a year and a half, 2 years ago, because interest rates are so much higher, because you can't buy a place without looking at a far higher monthly mortgage payment just because of those higher interest rates. When you're talking about north of 7%, if you add several more rate hikes on top of that, I mean, that is serious pain that it means to a lot of people.
No, look, there's no doubt about it. Increasing rates, by the way, too,
in housing.
Well, that's the dynamic, and in housing in particular, we have a supply-demand imbalance that's been built up for quite a while. So, look, the challenge, and Chair Powell is very clear about it. Inflation is, you know, an insidious tax on all of us, particularly the poorest among us. Raising rates has an impact on those who are in the market for housing, et cetera, for those that are in the market for those activities. Now, let's be clear, the vast majority of Americans are not in the market to buy housing right now. But if you are, it has become a much more difficult and challenging situation.
But rents have risen as a result. I mean, you can't find the same rents because the comparison to a monthly mortgage pushes up rents as well. And that's inflation that's going to stick around, too.
Absolutely. So all the more reason to try to get all these inflationary pressures out to get to the peak, and then hopefully things will settle. So raising rates is not without some costs, as you point out, but allowing inflation to pick up has even more dire consequences, and that, I think, is the Fed's focus and job right now.